Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Wolf Richter, publisher of WolfStreet.com. He's speaking to us from San Francisco. Welcome back to the show, Wolf.
Thanks for having me back, Jim.
Wolf, we have a question from Mike that was posted on How Street. He asks, please tell me if I have this wrong. It seems that the narrative in the financial community in Wall Street is that the Fed will backstop the financial markets even at the expense of Main Street. If the economy crashes, as so many believe, the Fed will just push the market higher with easy money as things get worse for Main Street. The more suffering on Main Street, the more money for Wall Street. Is that the case?
That is certainly a concern. And so let's separate that out a little bit. Main Street means people have jobs, they make money, and they spend money. And they save a little bit, hopefully. But for people to have jobs, companies need to do well because they're the job providers. And this could be mom and pop companies and self-employed people and small companies and medium-sized companies and large companies. So for Main Street to do well, business needs to do well. And when business does well, people have jobs and they make money. And when there's a demand for labor, then wages should go up and you'll have hopefully some positive feedback there. When Wall Street does well, that means that stocks and bonds go up. So stock prices go up and bond prices go up. When bond prices go up, it means yields go down. In other words, interest rates go down. So that's what Wall Street wants. It wants low interest rates and it wants high stock prices. And it wants a fairly predictable environment where the derivative products that are based on them don't blow up. And so you have these two things. And there's a connection between the two that even the central bank cannot separate. And it's been trying to do that, and that's one of the things that central banks have tried to do now for a decade, is sort of surgically remove Main Street reality from stocks and bonds. And they've pretty much done that, except for one thing. When a company defaults, its shares go to zero. And there's the debt restructuring, and the creditors get the equity, they get the company essentially. And if it's a privately owned company, the bank may take possession of it, or the bondholders may. And if it's publicly traded company, the old shares will be canceled, and there'll be new shares issued for the bondholders and other creditors end up with. And so when there are a lot of defaults, these companies get, in terms of the shareholders, they get annihilated. And that happened during the financial crisis. We had a lot of bankruptcies and restructurings, and including big ones like GM and Chrysler, and stockholders got just wiped out. And bondholders took a haircut, but they usually get something, but depending on the type of bond they had, but shareholders get wiped out. So when you have a situation where companies get in trouble and they cannot make the debt payments and they default on the debt, each individual company's shares will get either wiped out or will be essentially destroyed. And when you have one or two, it's no big deal, but we've had to now play out in the shale oil and gas sector where there were hundreds of shale oil and gas companies that, since the oil bust started in mid-2014, have gone bankrupt. And in bankruptcy, there's this restructuring, and some of them have restructured outside of bankruptcy, and always the shareholders got either wiped out or got decimated. And then we've had the same thing in the brick-and-mortar retail sector In Canada, it was Sears of Canada and some others. In the United States, of course, it was Sears Holdings and Toys R Us and hundreds of other retailers that didn't make the transition to e-commerce, and that just got wiped out, and they continued to get wiped out. And we had another one, the big one, Pier 1 Imports, and there's just a bunch of them. And each time shareholders get wiped out when that happens. So when the central banks create an environment where companies are able to take on too much debt, eventually this debt will come to haunt the companies, and they won't be able to deal with it anymore. And a company that doesn't make money and keeps funding its operations by borrowing money eventually will run aground. And investors eventually will say, no, we're not going to roll over this debt. We're not going to give you more money. And so what happens normally is you have a bond that comes due the matures, and the company borrows more money, issues another bond ahead of time, gets the cash, and then pays off the old bond with money from new investors. And when these new investors don't show up, when they say, we don't want to do this anymore, or if they demand such high yields because it's so risky, that the company can't really do it anymore, then the old investors don't get paid. And so that gets defaulted on, and that triggers a default and a restructuring and usually a bankruptcy, and sometimes a restructuring in bankruptcy and sometimes a liquidation. And so central banks have now created a business world that is infamously over-indebted. And so the last 10 years, and that's at every level, that's corporate, big companies, and corporate America is incredibly over-indebted. It's smaller businesses too have too much debt. Borrowing has been cheap and easy, and this debt will go away. It has to be refinanced. They make lots of money, like Apple makes lots of money. It can easily pay off debt over time and deal with it. But if you're a company like Tesla or Netflix that lose or have a lot of negative cash flow, then you have trouble paying off that debt on your own. You can't really pay it off. You have to refinance it, and you need investors to be in a good mood and give you that money so you can refinance your debt. And then when investors don't do that, you default. And this is the link between Main Street and Wall Street. It's the default. And when the default happens, generally companies are forced into restructuring, so there'll be layoffs, and stockholders will lose everything. Bondholders will get a haircut. Some employees will lose their jobs. The company will spend less money. So other companies have fewer revenues. And so it sort of ricochets through the economy. And when you have a lot of that going on, so when these defaults take on momentum, then Main Street is impacted by it. Until that happens, as long as companies are doing well, Main Street is going to do reasonably well too. Now, there's two other factors included that are not included here, and one is price increases, and that is a big issue. And so CPI, the Consumer Price Index, in the United States, has depending on which measure we're looking at, there's different measures, and they have ranged between 1.5% and 3% in recent months, depending on the measure we're looking at. And they have measured in about that range in the past many years. But when we look at the price of an F-150 pickup, and I've done this study, so I've gone back to 1990 and looked at an F-150 XLT, what the sticker price was, and what it is today. The sticker prices have gone up by 160% over that time period. And it's a huge amount increase. Now, nobody pays sticker price, but back then nobody paid sticker price. So this is a constant. You always get discounts and you always get rebates, and there's always something going on. So this is a constant. And a 160% price increase compares to the 22% price increase over the same period of the Consumer Price Index for new vehicles. So this is up index for PI, and it went up 22% by the way it is structured, whereas the actual price of the vehicle, the F-150 is the single most common, the single bestseller, the best all-time bestseller in the United States ever, and still is. That's why I took it, because it's the best selling vehicle we have here, and so its price increased by 160%, whereas the price index for new vehicles increased 22%. So that 2 to 3% increase in inflation that you see published all the time doesn't reflect actual price increases that you have to deal with. So if you're on a budget and you make $30,000 a year, and you're faced with price increases that may be 15% on rent, and it may be in the United States we have private health insurance, and so it may hit you with 20 or 30% on health insurance, and then after 10 years you buy a car and the price has doubled of that new car, then and you can't buy a new car at that point. You can't afford it. You step down to used, and then next time you step down to cheaper used. This is what's been happening. At the lower half of the income level, we have seen this issue where people have jobs, they have pretty decent jobs, but the incomes haven't gone up, and they're getting squeezed because of these price increases, these actual price increases in vehicles, in rents, in home prices. I mean, you guys in Vancouver are sitting on a prime example of enormous house price inflation, that, where incomes cannot keep up. And so this is squeezing Main Street through inflation, through price increases. And of course, price increases are good for business because it means they get more revenues, and it's good for governments because they get more sales taxes and property taxes and so forth. But it is terrible for consumers, people that have to make do with fixed income. And then it's another issue, a third issue that impacts Main Street, and that is the interest rate repression we've seen for the last 10 years. Low interest rates, we are good for homeowners. They're really bad for people on fixed incomes, for retirees, for savers. In the United States, there's $40 trillion worth of fixed income products out there. That includes $22 trillion in government bonds. That includes $10 trillion in savings products. It includes high-grade corporate bonds and municipal bonds and other instruments. And that's $40 trillion. It's owned by life insurance companies, by retirement funds, by individuals. And instead of making 3 or 4 or 5% on it, they're making somewhere between 1 and 3% on it, and right now between 0 and 1.5% a few years ago. And so their cash flows were destroyed. These life insurance companies cutting back the benefits and this is Main Street. This is the recipients on Main Street that receive this money, and their cash flow has gotten crushed. And so that's how they're getting squeezed. These monetary policies have destroyed their cash flows. And, so you have this link, but it's not obvious, so, Wall Street can do very well, and bond prices can be high, and bond yields can be low, while certain parts of Main Street are getting squeezed by these low interest rates, and a certain part of Main Street gets squeezed by the price increases that help corporate entities. And then, but everybody has jobs. So right now, the Main Street job situation is pretty good. It's better than it's been in a long time. That looks good. When we get a recession, that third element will fall apart, that these companies will start laying off people. And then, you have Main Street really in trouble, companies laying off and, shrinking, and they're not buying as much, so it kind of ricochets through the economy. But then that will spread to Wall Street because of the defaults. So that link can't be separated. Once these companies start to default and go bankrupt, their stock prices will individually will go to zero. And in terms of the overall index, if this happens enough, and with companies involved, this can be a major problem for Wall Street. So there's a link. And that was an excellent question, and that's always an issue. But there is a link between Wall Street and Main Street, and I don't think that Main Street can get in serious trouble without Wall Street either leading it into trouble or coming in behind it. They're just linked via these different mechanisms of default and also the inflation and the destruction of the income streams from fixed income investments. So it's a complex situations, but they're linked. There can be no such thing, I don't think, as a booming Wall Street with a total crash of Main Street. I don't think that can happen.
We'll have more with Wolf Richter right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Wolf Richter. Wolf, startup companies have gotten a lot of funding in recent years, and this has created a boom in the sector, but recently, numerous IPOs have flopped. So what's going on there?
Yes, an IPO is an exit for the investors. It's one of the exits. Investors invest in startup companies they have a certain time frame in mind, and then at some point they want to sell at a huge gain, either to the public via an IPO or to a big, deep-pocketed company that pays them a lot of money for this, such as Apple or Microsoft. And they've been buying hundreds of startups. And the IPO route to exit is kind of closed off now. We've had some big debacles last year with Lyft and Uber flopping big time after the IPOs, and late stage investors losing quite a bit of money on those IPOs. The WeWork IPO got scuttled, it just collapsed, and it didn't happen, and WeWork ended up getting bailed out from SoftBank in some form or fashion. This year, so far, we've had one very much hyped IPO, that of Casper, which retails mattresses. And one of those startups, there's many of those startups out there that are in a humdrum business. They're selling a retail business of some sort, and they're selling on the internet, and they're managing to get initial investors excited and get lots of funding, and then they spent this funding on advertising. And so Casper is one of those, is selling bedding, and so they had the IPO. Which was a fiasco, and the late stage investors, so people that put money into the company in March last year, at a valuation of $1.1 billion, so this was a unicorn company at that point, they lost about 75% of their investment. And so this is a cold shower for the venture capital community and late stage investors. They know that almost all of these startup companies have been overvalued, overpriced, and at these valuations, there's no real way to get out. You can sell them, and you can maybe do an IPO, but you'll lose money doing it from their most recent valuation. And so, as a consequence, funding has kind of dried up for a lot of these companies, and so we see that a lot now. Layoffs there's hundreds of startups that have now done layoffs, and they've pulled out of markets, and plenty of them have shut down entirely. And this happened starting late last year, and it's just an avalanche of it going on right now. And this is happening in San Francisco. There's all kinds of startups now laying people off, and some companies are not even startups. They've been around a long, long time, but they have sort of startup operations. Like Macy's had its tech center in San Francisco. That did its e-commerce site, and Macy's e-commerce site is one of the top 10 e-commerce retailers in the United States. And had 1,000 people at the tech center, and they're shutting it down. They're getting rid of all these people, and there's a few maybe that can find jobs in Atlanta and New York City, but most of them will be out looking for jobs. And the other startups that that have shut down, with people now looking for jobs. And there's still hiring going on. It's not like we have this flood of unemployed engineers. That's not happening. I mean, they're finding jobs still, but the funding is drying up, and these companies are cutting back. And VC funding, so venture capital funding is like the stock market. It can go down a lot, but it doesn't go to zero. So there will always be companies that get funded, and it's like there will always be a stock index above zero. It may go down a lot, and individual stocks may go to zero. And it's like individually funded companies, they may crash, and they may run out of funds and not get funded. But overall, VCs will fund companies, and they will continue to do that. It's just they'll be a lot more careful, and the valuations will be lower, and companies will be forced to develop business models that actually have some kind of plan to be profitable at some point in the future. Almost some of the IPOs or the companies that are getting ready for IPOs, the companies that went and had an IPO last year, had any kind of track toward profitability. Tesla's been out there for a decade, and it's still not profitable. Netflix been out there for a long time, and it's still cash flow negative. This is a real issue with that, and you cannot survive long term if you don't have a business model that produces a positive cash flow. And so this is the new thing. Every startup company has to prove that, or should try to prove that it has some kind of track to profitability. And if it can't do that, there's a good chance it will run out of funds, and it will not get any more funding. And this is a big issue in these hotspots, where there are a lot of startup companies, because this money that investors pour into this company gets spent locally. So it gets spent on wages, it gets spent on beer in the fridge, it gets spent on furniture, it gets spent on computer equipment, and as far as consumer-facing companies is concerned, they spend a huge amount of this investor money on advertising. And this advertising goes into social media largely, such as Facebook and others, and also search ads, so Google. And for like Casper, spend a third of its revenues on advertising. That's a huge part of what it spends money on. It's advertising, and that's its main thing. It makes mattresses, bedding, and sheet stuff, and it has to compete with everybody else that does that. And it does that by spending an extraordinary amount of investor money on advertising. And when investors pull back, this spending stops. And a lot of this money is spent locally, some of it is spent nationally, and so you have a ripple effect through these local economies that the employees are getting laid off, and they're not spending money after they lose their jobs, and advertising money doesn't get spent, and the furniture doesn't get bought, and the local craft brewers are not selling beer to these companies anymore. And so you have this ripple effect through the local economy, and we've been through that in the dot-com crash, and it hurt the San Francisco economy immensely. I mean, it was a very painful thing to go through here. And I think we're looking at a similar scenario now, and we're at just very early stages of it, but we can see it. These cutbacks are real. Investors cannot get out of these companies, stop funding it, and then these companies are not spending the money that they're not getting, and the employers are losing their jobs. So it just ricochets. And I think this year will be the year where this will be more defined. And we'll see that many of these people that get laid off will have a little harder time finding a job locally. They may have to move somewhere else. And we'll see that some of the supplies to these companies will get hit. We'll see probably starting to see the first dents in commercial real estate, because that they have been bidding up office properties like crazy with investor money. So that will go away. So we will see these pressures from that startup bubble that we've had that is now deflating. We will see those pressures go through the local economy for sure.
We'll have more with Wolf Richter right after the break.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Wolf Richter. Wolf, much of the economy depends on consumer spending, often with borrowed money. So how are consumers doing right now?
But if you look at the aggregate figures, consumers are doing well. Their consumer spending is up by 3 to 4% generally in the past 12 months, and retail is up. And retail meaning including e-commerce, which is booming. E-commerce is up by 17%. Brick and mortar retail is not doing well, but there's enough growth in e-commerce that it overcomes that. So consumers are spending, they have jobs, they're working. And so if you look at the aggregate numbers, it looks good. And that is being pointed out by the Fed and by other market observers. And the problem arises when you start separating it into layers. And there is one part of the consumers that are doing very well, and their incomes have surged, and they don't have any problems keeping up with rising home prices and the rising part prices and the rising healthcare costs and all those things. And many of them don't even need to borrow. They've got enough money and they've got investments, and the stock prices go up, and they get wealthier, and the house prices go up and they get wealthier. And so this group of consumers is doing exceedingly well. And then there's another group of consumers, and they're in real trouble because their incomes have not gone up as much, and whereas their expenses have gone up, and that includes purchases of vehicles, it includes housing. Many of them have been priced out of housing markets that can barely rent, and even that's going up. And these consumers are in serious trouble in terms of if they borrow. We now have seen subprime rated consumer debt default at record rates. In terms of credit card defaults, we have seen the overall numbers are good. In aggregate, if you look at all credit card defaults combined, all delinquencies combined, they're near historic lows. They look very good. But once you separate subprime out, it looks terrible. So subprime delinquencies on credit cards have hit an all-time high now, worse than during the financial crisis. The same with subprime auto loans. Almost a quarter of all subprime auto loans are now delinquent. And these are the people that got run over by price increases. They have jobs, they're working, or else they couldn't borrow money, but they're not making enough to meet these price increases. And price increases can come overnight. You're renting, and one day your rent goes up 15%. And suddenly you can't make ends meet. And you have credit card obligations, and you've got car payments, and suddenly you face 15% more housing expense, and the rent may be already 50% or 60% of your budget. And so this is a fiasco when that happens. Health insurance in the United States does the same thing. You get from one to the next, you get a big increase, and you may not have any room in your budget to deal with it. And so sometimes maybe you can cut back, and other times you end up having to default on some debts that you have taken out, including car payments or credit card payments. And this is a development we're now seeing that I have tracked. And it started a couple of years ago, but it's getting really bad. And I'm trying to figure out why that is. And these people are working. This is not an employment crisis like we had during the financial crisis. When subprime blew up during the financial crisis, it's because 10 million people lost their jobs, and suddenly they had no income. Now people are working. You know, we've had the best labor market in many years, and and there's some upward pressure on prices, but not enough. And so this is not an employment crisis, and yet we have this issue of subprime exploding, and it's happening in a relatively limited layer of the consumers, and so the overall aggregate numbers are still looking pretty good. But in this layer, even though we have what some call the best economy ever, you know, that's how it's being described in the White House. We have this layer that's getting in real trouble, and it's getting in trouble while these people are working. And so we may eventually get a recession, and I can see that this year, and that will be much worse for this group, and they start losing their jobs. But already with the labor market as strong as it is, that part of the population has gotten run over by price increases, by house price increases, by rent increases, by health insurance increases, and for them it just doesn't work anymore.
Wolf, thank you so much for being on the show.
Thank you, Jim.
My guest has been Wolf Richter, publisher of WallStreet.com. He was speaking to us from San Francisco. If you have any questions for Wolf or any of our other guests, you can send them to info@HowStreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.